Arlington Neighborhood Village for inviting me to be here today. Again, my name is Isabel Barrow, and I'm an executive director of financial planning at Edelman Financial Engines. I'm based out of the Alexandria, Virginia office. I'm in Boston today, but I'm usually in Alexandria, Virginia. So today, my goal is to talk through some of the tax planning ideas that might help you this time of year, but also as you think more generally about your longer term tax planning. But I do want to say I am a financial planner. I'm not a tax advisor. So before you implement any of these ideas that we're going to talk about today, I would certainly recommend running them by your tax expert, your tax advisor, CPA, whomever you work with to do your taxes, to make sure that any of these actions that you take are suitable and in your best interest. But that being said, as I and as my colleagues at Edelman Financial Engines think about overall financial planning, tax planning is a really important piece of this, because even small changes in the way that you are doing things can actually have a fairly outsized impact on your tax bill, and thus your overall expenses, and then potentially your long-term wealth. So we do want to certainly think about tax efficiency as part of an overall financial planning process. For example, we know that for those who are on Medicare, it's really important to know this time of year how much income you're projected to have for this year, as you might need to plan or strategize around the potential of running into IRMA or income-related monthly adjustment amount. In other words, that extra Medicare premium that you have to pay if your income goes over certain levels. So if you're close to that next IRMA bracket, you might want to consider, for example, tax loss harvesting to offset capital gains, or take the extra $3,000 in losses against ordinary income, or maybe it's considering a qualified charitable distribution, also known as a QCD, instead of taking your full required minimum distribution. So these are just some examples, but my goal is to talk about all of these in more depth today. So as Gary said, hold questions if possible until the end, because I might be able to answer them through my presentation. And my objective is to provide practical strategies to really optimize your tax outcomes. And so we'll talk about required minimum distributions, Roth conversions, and when that might even benefit you from a tax planning perspective. I already mentioned qualified charitable distributions and how that works, or how that might work for you as an alternative to a deductible or maybe even a non-deductible charitable contribution. I'll talk a little bit about using donor advised funds as well, another tax strategy. Tax loss harvesting. What is that? When can you do it? How do you do it? And we'll also talk about municipal bonds and what I call tax location, strategic location, which is having the right type of investments and the right type of accounts. Another thing that I'm going to add in here is some of the tax benefits for seniors and retirees, both from a federal level, but also in Virginia and Arlington specifically. So let's talk about that first. So let's talk about the tax benefits you may want to be aware of as you get ready to file your 2024 taxes as a Virginia resident, Arlington resident, or a senior over 65. So we'll start with federal taxes. And as you may know, recent changes in tax legislation made it so that most people are now better off using the standard deduction instead of keeping track of and itemizing their deductions. And so that makes a really big difference as we think about things like charitable donations, or maybe your medical expenses that you were tracking in the past in case they were deductible, because typically, if you are itemizing, you can deduct medical expenses that are over 7.5% of your adjusted gross income. But nowadays, because the standard deduction is so high, it might be greater than what you can itemize in your deductions. And in states with taxes, like state taxes, like Virginia, it's even more likely than in the past that, you might be using the standard versus itemizing, because we lost the ability to deduct the full state taxes, the full personal property taxes, and all of that is now limited to $10,000 in what they call SALT taxes, or state and local taxes. So let's talk about the standard deductions for seniors. So typically for 2024, the standard deduction amount is $14,600 for single filers. And if you're married, and also that's if you're married filing separately. If you're married filing jointly, or you're a qualifying widower, it's $29,200 as the standard deduction. But if you're over 65 in 2024, so for the taxes that you'll be filing this, that's coming spring for this year, the additional standard deduction is $1,950 if you're a single filer, or you're filing as head of household. And if you're married, filing jointly or separately, the extra standard deduction amount is $1,550 per qualifying individual. So per person over 65 if you're married filing jointly. So that's just something to keep in mind, that there is that extra, on top of the regular standard deduction, you might qualify for that extra standard deduction, making it even less likely that you'll be itemizing. I think, at this point, most of the time, itemizing is only beneficial for people who have maybe a big mortgage or large expenses related to long-term care or medical expenses. So it's not anywhere near as often as it used to be that you're going to be itemizing. So be sure that you're using all the deductions that you can from a standard perspective. There was another change specifically to residents in Virginia I think it was probably in the last 2 years. And those changes were specific to military benefits. And so it's something called the military benefits subtraction, or military retirement subtraction. And Virginia recently changed their state tax rules to allow a partial tax break on military retirement income, so the military pensions. And those have to be taxable benefits, so it's not related to VA or disability income, but related to your pension or your military retirement. So they must be included as income on your federal tax return, but then on your Virginia return, you can deduct up to $30,000 of those eligible military benefits for 2024. So for this year, and next year in 2025. It's actually going to be $40,000 of your eligible military benefits can be deducted off of your state taxes. That was a change starting in 2023. So you may not have been aware of that, or, it may be that it's increasing for you, or you're now qualified for it. So if that's you, be sure to work with your tax preparer to make sure that you're claiming that properly. So some more benefits for Virginia seniors. Virginia also, this is, again, talking about your Virginia state taxes. Virginia offers those who are qualified, those over age 65, a subtraction, essentially, that reduces the amount of your income that is subject to Virginia tax. If you were born January 1st, 1939 or earlier, you can subtract $12,000 as an age deduction from your Virginia taxes. If you were born after that, so January 2nd, 1939 or later, the amount of that deduction, or of subtraction, really is based on your income. So again, specific to your Virginia state tax filing, and something that you want to be sure that you're collecting properly, or you're filing properly with your CPA or tax specialist. So I also mentioned talking about people who live in Arlington. And if you are a real estate owner in Arlington and you are over 65, or you are permanently and totally disabled, you might qualify for a full or a partial break on your property taxes. So there are some qualifications to meet this. You must be 65 years or older. And if you turn 65 in the current year, the amount of the exemption is going to be based on how many months of the year that you were 65. You have to be a resident of Arlington, and the home that you're in Arlington has to be your sole residence. And all owners who are on the title have to reside in the property as of this year and to continue residing there unless you're in a nursing home or an assisted living facility. But there are income requirements and asset limits in order to qualify for that property tax relief. And if you don't qualify because of your income or assets, you might actually qualify to defer the taxes and therefore not have to pay them until you sell the property. So the asset limits, income limit is around 104,000, and the asset limit, excluding the home, cannot be more than around 486,000. I'm rounding a little bit, but it's all information that your accountant should be able to provide. So if you're below those levels, you may qualify for a full or partial exemption from paying those property taxes. So those are some things that you can think about in terms of deductibility and, deductions or subtractions on your taxes. So just kind of the basic stuff, but I want to move on to talk about some actions that you can take throughout the year to reduce your tax bill. So it's, those are things that are kind of automatic, but we want to think about ways that you can actually be more efficient with your tax bill through your investing process than you may be now. And so one of those areas is tax loss harvesting. So what is tax loss harvesting? Essentially, tax loss harvesting is the process of selling underperforming investments, underperforming securities, assets, to offset a capital gain, perhaps, or it could be to generate a capital loss that you can then take to offset ordinary income. Now, to be clear, this is only something that you can do with after-tax money. So a non-IRA account, a non-Roth, that might be a trust account or a brokerage account, an joint account, investment account, non-IRA. Tax loss harvesting is not done, is not effective, is not useful inside an IRA or a retirement account. Tax loss harvesting is most effectively done in working with a financial advisor, financial planner, who is monitoring the accounts on a regular basis. Maybe it's you if you're looking at your stuff really often, looking at your cost basis. You may be able to effectively do that as well. But it's much more effective when you're looking at this process throughout the year and taking losses when it makes sense, rather than, for example, just in November or December, looking at it once a year. When you're thinking about tax planning, we've just had this conversation and you say, you know what, I'm going to take a look at that. It's still great to do, but it's more effective when you implement it into an overall strategy throughout the year. So essentially, the goal here is to sell those underperforming holdings at a loss, and then do one of two things, most likely two things. The first of which is you sell the holding, and then you wait 31 days to repurchase the same holding. And the reason why you want to do that is to avoid something that the IRS calls a wash sale. Or you might buy an alternate holding to replace the one that you sold. So you either sell holding A, you wait 31 days and you buy holding A back, or you sell holding A and you buy holding B to replace it. Or maybe you don't buy anything at all. You keep the funds in cash until you determine, what you want to do with that money or how to use the proceeds. But what you've done in that case is you have taken a loss, paper loss, that can then be used to offset perhaps capital gains that you may have from other holdings or other investment accounts, or that investment account that had generated capital gains from other transactions. Like through a mutual fund that has distributions, or maybe you sold other securities or holdings within that account at a capital gain. So you're using this to offset that. And If you don't have capital gains, or if your losses that you're realizing are greater than those capital gains for that particular year, well, you can deduct $3,000 of that capital loss against ordinary income, which might be at a higher rate than your regular capital gains rate. So that's really helpful. And you can then carry forward any of those unused losses for future tax years. So for example, let's say during the year, you review your long-term capital gains that you've generated in this taxable account, and it's showing you have $20,000 in long-term gains. And then you review your positions and you see, okay, there's a couple of positions that are showing unrealized losses. I haven't sold it yet. And maybe it's $25,000 in unrealized losses. Well, you can then go through, sell those securities at a loss, wait 31 days to buy them back, and realize this loss of $25,000, use $20,000 to offset those $20,000 of capital gains you already generated from other sales, take $3,000 off of your ordinary income, and then keep the remaining $2,000 to carry forward to use next year to either offset income or capital gains. But remember, a really important thing about tax loss harvesting to know is the wash sale rule. So you cannot sell and buy back the same holding until after 30 days has passed. So, if you're selling a holding that you like and you say, I think it's just at a loss right now, but I like it for the long term, you have to wait until after 30 days to buy that holding back. Or oftentimes what we will do for our clients, and what's a useful strategy that financial planners will often implement, is to not buy back the exact same holding, but to buy something that's similar, so that you're not out of the market for that investment, that pot of money. You're selling it, you don't want to let it sit for 30 days. You buy something similar. So for example, that might mean maybe you're selling an S&P 500 fund and you're buying a Wilshire 5000 fund. So it's not exactly the same, but it's a broad-based index. And so you're kind of getting the same type of investment, the same type of performance. It's not exactly the same. So the IRS says that's not a wash sale. You still get to take your loss on paper, but you don't have to sit out of the market for 30 days. So that is tax loss harvesting. Next, I'm going to talk about Roth conversions. And I'm talking about this because we have really seen an uptick in not only questions about Roth conversions, but actual Roth conversions for our retired clients. In part, that's probably due to the fact that the Tax Cuts and Jobs Act was potentially going to be expiring at the end of 2025. And so that act reduced tax rates for many people. And since it was set to expire, the concern was, what if my tax rate goes up in the future when I'm taking required minimum distributions? And, Tax Cuts and Jobs Act doesn't, just ends and tax rates go up. I'm going to be paying more when I'm taking my RMD out. So it may make it attractive to take some income now in a lower income tax rate. So Roth conversions have become a little bit more talked about recently. Now that we have the administration coming in here next year, it's not clear if that act will be extended beyond 2025 or not, but it's certainly more likely. So that might reduce the need for Roth conversions, but it's still a really useful thing to consider in case there are opportunities for you to use this to your advantage. So it is important to remember that a Roth conversion only makes sense if you expect your tax rate in the future to be more than what it is right now. So when you take into account the amount that would be added to your taxes through the Roth conversion, because you're taking something out of a traditional type IRA, paying taxes on it and converting it to a Roth. So you have to add that money into your total income and now recalculate what your taxes are going to be with that distribution. That would have to make sense, that new tax rate would still be lower than what you were expecting in the future. So mathematically, there is no benefit to you if your tax rate is the same. Also, another key thing to remember about any Roth conversions you do is is there's something called the 5-year rule for Roths. And for conversions, there is a rule that every dollar you convert, you have to wait 5 years before you can take out the earnings off of that conversion. So it basically means it's really complicated to get access to the money if you're converting money that you want to use really soon. So it makes sense if it's money you're going to be leaving for a long time, not going to be touching it, and you want to pay taxes now because you think your tax rate is lower now. Also, Roths can be really helpful from an estate planning perspective, in part because they're more desirable to inherit because they're tax-free to your beneficiary. But also using a Roth means you're reducing the size of your estate by the amount of taxes that you're paying, which could then reduce your estate taxes if you're one of the lucky few to have enough to be worried about estate taxes, which is right now, and this year, it's a single with 13 million or more, or a couple with 27 million, roughly. So if you're one of those and you've got estate taxes to worry about, Roths may be a great option as well, thinking about Roth conversions. Roth conversions are attractive for people who are concerned that their required minimum distribution when they're 73 is going to be large, and they are going to then be pushed into another much higher tax bracket, and their effective or your tax bracket now is lower. So how do you know if it's right for you? Well, there's software that you can kind of run an analysis. If you work with a financial planner, at Edelman Financial Engines, we have software we'll run tax return through to take a look at where are you now, and then we'll run some models to see, okay, if you do a conversion, here's how much you can afford to do before you're running the risk of IRMA or are pushing yourself into a much higher tax bracket. And so you also want to think about the risk of that Roth conversion, because if you convert too much, you can also run into some issues with your Medicare premiums. So, for example, if you are let's say 65-year-old couple, you have income of $75,000 from Social Security only, and you have large balances in your IRAs, a Roth conversion of some amount, maybe $100,000 or less, might make sense for you as long as you're not putting your income over $206,000, which in 2024 is the limit for what I've been referring to as IRMA. That's income related monthly adjustment amount. You may get letters on this from Social Security Administration, but it's the extra Medicare premium. So IRMA kicks in for single taxpayers with income over $103,000 this year, and couples over $206,000. So that's one of the risks of converting too much into a Roth. And even $1, by the way, over that 103 or over that 206 could mean that your Medicare premiums so each individual, each person in the couple go up from, $175 a month to $245. And then it keeps going up from there the more you make or the more you've converted if it was from a Roth conversion. And those amounts do change every year, and the IRMA is a 2-year look back. So it wouldn't impact your Medicare premiums the next year, it would be the year after that. Also, in order for a Roth conversion to make sense, you would have to be able to pay the tax on that converted amount from a non-IRA account, like a bank account, a brokerage account, and not have it taken out of the conversion itself. So I'm going to move on to qualified charitable distributions as a tax strategy. So, and that's also called a QCD. So you'll hear it both ways. And when we talk about charities, it's important to understand that means an organization that is recognized as a 501c3. I'm also going to talk about what assets make the most sense to gift through QCD or otherwise, and why. So in many cases, when people are making a donation to a charity, they're simply writing a check or they're transferring stock or mutual fund to the charity. And that strategy is great if you're gifting low basis securities, you're avoiding capital gains on those, et cetera. But it's great if you're getting a tax deduction for it as well. And like I said before, this might not be the case anymore because so many of us are no longer itemizing our taxes and instead are using the standard deduction. So that means you might not be able to deduct the full value of your donation. And even if you are itemizing, there might be limitations on how much you can deduct as a percentage of your adjusted gross income. So, if you donate $100 and your AGI is $100, you're not able to take the full amount as a deduction. So if you're not itemizing, or you want to gift more than what would be deductible for you, even if you are itemizing, consider a qualified charitable distribution. And so this is for people who are 70 and a half or older. If you're 73 or older, you have a required minimum distribution, but the QCD is allowed for anybody 70 and a half or older. It is not applicable for a Roth IRA because you don't have an RMD. It's traditional or rollover SEPs, et cetera. So when you take this, you're taking a distribution and you are not paying taxes on it at that time. And as I mentioned before, if you're not itemizing, you're not able to get a full deduction, but under a QCD, you can contribute up to a total of $100,000 from your IRA directly to a charity and avoid paying income tax on that distribution. So it doesn't matter what your RMD would have been, you're allowed to give up to $100,000 directly to the charity from the IRA, avoid paying taxes on the distribution. The charity also doesn't pay taxes on it. So it's not included in your income, all right? So that is limited, as I said, to non-Roth IRAs. And there are some other exclusions and considerations as well. So you want to be sure to talk to your advisor or your tax preparer before you move ahead on it. But the benefit is you're giving to a charity now, and that's a gift that you can see and experience the value over your lifetime. And you're saving taxes on it. That money would have otherwise been reportable as taxable income. And in this case, it's not included when you give it directly to a charity. So it doesn't have to be your whole RMD. It can be a portion of it. And like I said, up to $100,000. You can make a QCD to multiple charities. You can make you want to give it to 5 different charities, or you want to give half to 5 different charities and the other half for yourself, fine. And it's also optional every year. Doing it once doesn't mean you have to do it again. But something that you can opt into depending on what your taxes look like. You do have to do it the right way. So it's typically done through the IRA custodian. So you fill out a form through whomever holds your IRA for you, and they send the money directly to the charity. The charity sees that it came from you. You get a tax form early part of the next year, a 1099-R that shows that you made that distribution and it met your RMD or was more. But it may not notate that on the tax form itself. So you have to keep track of it, make sure your CPA or tax preparer knows about it, or that you're recording it properly in software if you're doing it on your own. So it's a good strategy if you're trying to reduce your taxable income in any one year and you know that those are funds you don't need. Obviously, it is an irrevocable gift. So you're gifting it out. It's money that's not, it's going directly to the charity. But if you're one of those people that your RMD is going to put you into the qualifying for or reaching those IRMA levels, the extra Medicare premiums, that might be a really good option as a way to kind of avoid that. Even a small gift, as I said before, you even go $1 over the 103,000 or the 206,000, and you're falling into that IRMA. So even making a small QCD might prevent that. Next strategy is the donor advised funds. So that's just another way to gift money to charity. A donor advised fund in and of itself is essentially a charity. So it's an account that you open that is designed to invest, to grow, and then to give assets to your charities of your choice, either immediately or over the long run. So investing some now, letting it grow, and then gifting it out later. There are a few custodians who offer these, and once you set it up, you basically make a donation into the donor advised fund. You get the money invested right away, just like a 401k would be, for example, in a diversified portfolio. It's growing over time, and then you're later designating a charity, specific charity or charities of your choice to receive those funds out of the donor advised fund. And you can do that as one one donation or one grant, or you can do it over time. So for example, this can benefit people if you make a gift into the fund in one tax year, get a deduction for it, and then you gift out those funds, again, called a grant in the case of a donor advised fund, you're gifting the money out in a subsequent tax year. So your deduction is based on the year that the gift went into the fund, not the year the donation is made to the charity. So, this can be helpful if you're looking to get a big tax break, right, to make a large gift, but you want to control how quickly the charity can receive it. You want to give it to them over time instead of giving it to them all up front. Or you haven't decided, where you want to gift the money yet, and you want to make that decision later. So that's called bundling. It's where you make a large donation into a donor advised fund in 1 year, and then you spread out the distributions to charities over multiple years. But allowing you in the year you make the donation to take a big deduction that you wouldn't have otherwise been able to do to get above your standard deduction. Let's see, I'm going to skip over some of this stuff, the donor advised funds. Another thing about the donor advised fund that you might think about is, okay, well, what if I don't gift it out over my lifetime? There's still money in it. What happens to it? Well, you can name a family member as an heir or successor, and then they can decide what charities to support or make grants to. So it's also, a useful estate planning tool, and it's leaving a legacy of charitable planning. Now, these donor advised funds can often have high minimums. So I think, it's not at all unusual to have a $25,000 minimum account to, minimum donation to get the account started. And there are costs associated with it. So administrative fees, there might be costs of the underlying investments, just as there would be in any investment account. And as I said, it's an irrevocable gift. So once you put it into the donor advised fund, you can't get it back if you need that money down the road for something else. So, in that case, obviously, you want to make sure that your own financial planning is really squared up before you are gifting money into a donor advised fund or through a QCD. Okay, so last but not least, I'm going to discuss asset location and how to use that to your advantage. And considering using municipal bonds. So this strategy is essentially asset location is essentially putting the really highly taxable types of investments that could be things like bonds, real estate, certain sectors like utilities that are really highly taxable. They have big dividends or income that's pushed through, and holding those types of assets inside an IRA versus inside your taxable accounts. So because in the IRA, you're not going to pay taxes on those distributions and income, et cetera, and you are in a non-IRA account. So consider holding those really highly taxable assets inside IRAs and not pay taxes on them, and inside your non-IRA accounts, so your brokerage accounts, trust accounts, et cetera, holding your lower taxed investments. That's things like individual securities, individual stocks, maybe index exchange traded funds, and municipal bonds. And that will then result in what would otherwise, from taking a higher 1099 into a lower 1099. So just having less taxable distributions. Municipal bonds are federally tax-free and maybe state tax-free if you're buying bonds of the state that you live in. And the benefit is typically for those who are in 35% or higher tax bracket. So if you are in a very high tax bracket, using municipal bonds instead of other types of bonds inside your brokerage account can be really effective. Now, the reason why you may not want to use municipal bonds in a lower tax bracket is because they pay a lot less than a traditional bond that would have the same quality or the same rating. So they pay less because they're tax-free on a federal level and maybe on a state level as well. But the advantage is, of using them, and the advantage of tax location in general is keeping your tax rates lower. The challenge is if you're already fully invested, it's going to be a lot of overhaul or upheaval to move stuff to move stuff around, buying and selling, and, could generate additional taxes. So that strategy, asset location, and, making sure that you have the right type of investments in the right type of account is really best for someone who has new money to invest. So maybe that's an inheritance, or it's a home sale, or some other type of windfall. Because as I said, otherwise trying to sell and move things around in order to create this lower tax investment portfolio might inadvertently create more taxes through all the sales and transactions in the short term. So to wrap this up, the last couple of comments I want to make are to remember that, this presentation is for education, and it's not meant to be tax advice. This is really meant to be more financial planning and thinking about how to be most efficient with your money. So questions about specifics to your tax, your tax rates and what's best for you, make sure you're seeking advice from your tax preparer to utilize any of these strategies, or your financial advisor. Run some tax planning analysis, see if the Roth conversion makes sense for you, and help you understand whether or not those are things that you should be considering as a long-term strategy in your overall financial planning. And also just a reminder that, at the end of the year, it's a good time to review, adjust your portfolio. You should be doing that on a regular basis anyways, but keep up with the changes you need to make. You should be rebalancing regularly, keep to your desired asset allocation. And remember the tax implications of selling investments to rebalance, and be sure that you're doing that strategically and looking for losses, etc. So I think that's it for now, and maybe we'll start taking questions, Gary, if we have any. I just want to thank you all for your attention and for listening to me go on and on about taxes, and hopefully it was helpful.
All right. Well, we do have a number of questions. One of them, if you use something like TurboTax, are things like the standard deduction calculation and the extra adjustment for being over 65 automatically included in the software?
I don't
Do you
know. I don't know. Maybe somebody else on here knows, but I don't know. I don't use TurboTax. I am a big believer in using tax professionals to catch the mistakes that I might be making otherwise on my own. So I typically recommend go to a CPA, go to a specialist, unless you are one on your own, or you really know your taxes inside and out.
Okay. If you have a supplemental annuity income plus the required minimum distribution, is it still advantageous to itemize or take the standard deduction?
Well, it depends on which one's greater. Ultimately, I mean, you are itemizing if your itemized deductions, when you add everything up, is greater than the standard. So you just take whichever one's larger.
Does Virginia tax Social Security income, and does it depend on your adjusted gross income?
Virginia does not tax your Social Security income. So you do not pay state tax on Social Security in Virginia. How Social Security is taxed is a little bit complicated. Under certain income thresholds, you don't pay tax on your Social Security on a federal level. But most people, and in this area, most people, and if you started taking Social Security at 65 or older, your Social Security is over a certain amount, you're going to pay tax on most of that. So there are 50% threshold, 85% threshold, but in Virginia, you do not pay tax. You do pay tax federally for most people.
Okay, we've got a comment here. For this person, the big difference between federal and Virginia income tax returns has been that Virginia allows subtraction of long-term care insurance premiums. So
Correct.
if you're paying that, that's something to pay attention to. Another question, when you were talking about QCD, she thought you heard you use the age 70 and 1/2. Isn't the age higher? And I think they're confusing the required minimum with the QCD.
Yep. So two different ages here. The QCD is allowed at age 70 and a half or older. The required minimum distribution for most people right now is age 73. But for anyone born 1960 or later, the required minimum distribution actually starts at 75. So there's three different numbers to remember here. But the qualified charitable distribution means you can start at age 70 and a half, and you have to wait until you're actually over 70 and a half. You can start gifting up to $100,000 directly out of your IRA to a charity and not pay tax on that as income. So you're taking money out of what would otherwise be a taxable IRA, giving it directly to a charity and not paying tax on it. And you can start that after you have turned 70 and a half, unrelated to your required minimum distribution. The reason why they're kind of related is that instead of you having to take a required minimum distribution when you're 73 or maybe 75, depending on how old you are, you could alternatively send that entire required minimum distribution directly out to a charity via a QCD and not have to pay tax on that. In every other circumstance, you've got to take that as per the IRS rules every year and pay taxes on it. So it's really the only way you can avoid tax on the required minimum distribution.
I'm going to just interrupt because that was my question. So are you saying that I can, if I use a QCD early at 70 and a half, not early, at 70 and a half,
Yeah.
that I'm taking what would have been my RMD early?
No, it has nothing to do, if you're at 70 and a half and you don't have a required minimum distribution, it doesn't have anything to do with it. But what it is doing is reducing the size of your IRA so that when you later have a required minimum distribution,
Okay.
that calculation is based on a lower number. But it won't, you're not prepaying, like you're not pre-withdrawing
Right.
your RMD, unfortunately.
Thank you.
Mhm.
If you put a bequest in your will for a charitable organization, is there a limit on the amount for estate tax or the organization's tax reporting?
No, I mean, you are allowed to gift as much as you want, to a charity in your lifetime or through a bequest or through your beneficiary designations. I mean, right now, like I said before, the estate exemptions are around 13 to 27 million, depending on if you're single or married. That is not includable in estate taxes anyhow. So unless your estate is over that amount, it's not even a consideration of like how much you're allowed to gift or anything. And even then, even if you were over that amount, those donations and those bequests directly to charities are exempted from estate tax anyhow. You're not paying tax on it as part of your estate. You're gifting it out to a charity. So really shouldn't be any limitations there. But, if you have a large enough estate that and you don't have human beneficiaries, family beneficiaries you're planning on leaving money to, and you want to leave money to charities, then you should think about whether or not there's some value in your taxes now in potentially doing some of that through a donor advised fund or through, QCDs and reducing your estate, therefore reducing your future RMDs, just from a tax efficiency perspective. Again, if you have enough money that you're not worried about running out, maybe gifting some now is more efficient for you overall from a tax perspective than waiting until later to leave it all through bequest.
Okay, and if you're giving to a charitable organization, there's no limit that suddenly they have to start paying taxes on it?
There is not.
Okay. Do you know when the IRA RMD calculations for 2025 will come out?
I don't. They're not out yet, and as of today. So, and I don't know. Usually it's the end of November, so I would think maybe another week or two.
Okay. And we've got a question or an answer here that says, yes, TurboTax includes all those tax provisions. So that's
Yeah.
going to be taken care of. One question I had is you've talked a lot about IRAs, but haven't said anything about 401ks. Are all the same things you've said applicable to a 401k?
No. So
Okay.
401k is actually really different. You cannot make a QCD from a 401k. So you would have to roll over to an IRA. in order to make a QCD. The RMD calculation for a 401k is different than what it is on your IRAs. So for example, if you have 4 different traditional IRAs, you have one with Fidelity, one with Vanguard, one with Schwab, and one somewhere else. The IRS will say you have an IRA worth XYZ dollars, right? So they look at all 4 of those as one IRA. The 401k is actually calculated completely separately. You also cannot make a Roth conversion out of a 401k. So you would again have to roll money out of the 401k and put money into an IRA in order to make a Roth conversion.
Okay, an interesting question. If you write covered calls, is the income received considered short-term gains regardless of the expiration date?
Not a question that I can answer because I would consider that tax advice. So unfortunately, something that I would refer you back to your CPA to answer for you.
Okay. And I think that covers the questions we've got. So if anybody else has anything.
I was going to ask you something, and that is, in terms of paying a tax consultant, how can you talk a little bit more about how to determine who to go see? I mean, you represent a particular company, but sometimes people go to, I can't think of the name that's been around about 100 years.
H&R Block.
Exactly.
Okay.
And so can you talk about how the fees of tax preparers or tax consultants are determined so that people kind of have, especially if they're looking for somebody else?
Yeah, so I can give you information, right? And sort of my 2 cents on it. I am not a tax advisor, and Edelman does not employ tax advisors other than those who were used to consult on our clients' tax returns, not file their taxes for them. But just from clients that I work with in my own experiences, I'll tell you that, typically it's based on how much you're paying to a tax specialist or a CPA accountant is based on how many documents they have to file for you. So, how many schedules are you adding? So if your taxes are fairly simple and, you're not itemizing and you're just taking standard deduction, you don't have a whole lot of complexity, it might run probably, I would say, in the ballpark of $500 to $1,000. So that's what I've seen typically. And then when you start adding more and more schedules and more tax forms to that, more complicated situations, if you have, partnerships or LLCs or real estate holdings or very complex itemized deductions, or you're self-employed, each one of those things is going to add on a couple $100. So it's kind of unique to you and what your tax circumstances are in order to answer that question. But I think, my advice is when it comes to accountants, and what I always say is like, it's a tricky thing, because if you're a great accountant and you have, 100 clients who love you and they tell all of their friends to go to you, and the next thing you know, you have 500 tax returns you're trying to file in April, right? You're maybe done. So you're not taking new clients anymore. So then you've got to hire other people to work for you who maybe not as good at taxes as you are, but then they'll learn. And so it's kind of one of those things that when I start making referrals to accountants, I always say, like, you might work with this person or they might end up sending you to someone else. I think the best way to work with anyone, any specialist in any area, like a financial planner or accountant or an estate attorney, is through referrals from your friends. Referrals from people that you trust, someone who's been working with them for a long time. As long as they're taking on new clients and, you've been referred, I think that's the best way for me to go about finding a specialist in any one area. But again, it's such a long-term relationship that a lot of these accountants, they have their however many couple hundred clients and that's it. They can't handle any more tax returns. So it depends.
I also wonder too, if sometimes, depending on, again, how complicated or not complicated, if you have a lot of documents and this kind of thing, I'm wondering if nowadays tax consultants or tax advisors are reluctant to take a lot of, pieces of paper as opposed to getting things, you know, online or, you know, sending documents
Yeah.
or attachments. Any thoughts about that?
Well, I think, you know, most of the time, what my clients are asked to do with their accountant is to upload things through an accountant might have like a secure portal
Mhm.
where, you know, as you get your tax forms electronically, for example, you're just able to save that PDF over into the accountant's secure folder online. So it's much less likely these days that an accountant is going to take, you know, a folder like in the old days, you go in with your receipts and all the, you know, everything. That doesn't happen anymore. You know, they're asking you to upload everything electronically, but it's the same if you're using a TurboTax or a Tax Act or, you know, one of the online tax programs, right? You're not giving them paper either. You're having to trust this online storage system to take all your documents. So, you know, yes, I think it's more likely that it's all going to be electronic, but, you know, since the CPAs are getting paid by the, you know, essentially by the page, I would think that, you know, they're not going to be averse to taking a more complex situation. It's just that you're going to pay more for it.
Right, right. Okay. Okay.
All right, well, I've got one question that was emailed to me. Could you or Edelman provide a list of the state attorneys or some guidance as to where to go to find estate planners?
I would answer this in the same way. So for my clients, I do have some referral lists for CPAs and for estate attorneys that, you know, I will provide. I don't think I can provide them on this format because I don't have their approval to do that. But my advice is the same as with an accountant. Estate attorneys are a little bit more transactional. So, you know, they may only do one estate plan for a client every 5 or 10 years. So they have more bandwidth to add more and more clients. So it's not quite as challenging as it is with a CPA, for example. So I think the best way to go about that is, again, through referrals from friends and family, colleagues, you know, people that you trust who have worked with these attorneys. So like I said, for my clients, I do have a list of a couple of local estate attorneys. But I think a better way for the broader group is through, you know, internal referrals.
Okay,
Anything else, Gary?
yeah, somebody said they've been using TurboTax and the charge is usually $350 or so with itemized deductions. Just a comment.
Yeah.
Okay.
Yeah. So an accountant is very likely going to cost more, but it's the question of whether or not they save you more than they cost you. You know, it depends. Depends on if you know what you're doing and how good you are at it, and also how much you like doing it. I personally hate nothing more than doing my own taxes, and so it's worth it for me to pay someone to do it so that I don't have to sit there and do all that data entry. It's not worth my time. So I personally prefer it, and I have always found it to be a pretty easy process.
Okay. Well, it's 10:58, and unless there's anybody else has any final comments, I think we will close this out. And we definitely want to thank you, Isabel. That was very enlightening, and it sets us up for what is soon to come. So,
Yes.
thank you.
Thank you so much for having me. Thanks everyone for listening in.